Hi, welcome to my channel. We're starting a new discussion session today, capital budgeting. Capital budgeting is related to long-term investing decisions by business firms. Let's see in this session what does capital budgeting means, what are the terms associated and the related basics. Let's start by discussing what is capital budgeting and long-term investing. Long-term investing decisions are quite hard to make by the management. This is because once these decisions are undertaken, funds are allocated, it cannot be taken back. It cannot be mounted back. For example, if you have undertaken funding of project X and project X outcomes, decisions when implemented doesn't come out to be what it is to be thought of, then decisions can't be reversed. That means a lot of funds will be lost. Profits will not be realized. So this means growth opportunities will be lost if a project in which funds are being allocated doesn't come out on what it is to be thought to be. So before investing, managers need to undertake a detailed discussion of where to invest, why should the investment be made, and they must find out how the investment is going to impact the valuation of the firm, the profitability of the firm, and how much wealth it will be able to create. So long-term investing is really about where should the investment be made, how much funds shall be allocated, and whether we should invest by borrowing or by taking a loan, issuing new shares, etc. The nature of investing decisions involve capital expenditures. The long-term investment decisions are generally termed as capital budgeting because these decisions are long-term decisions which involves investing in long-term assets. Certain decisions regarding expansion of a business, acquisition of a new business for a firm, modernization of the business by replacing old assets. They are often known as long-term investment decisions, and investment decisions of these nature are capital budgeting. So overall, we will refer to these decisions as capital budgeting decisions. The features and importance of investing decisions depends upon four general factors. Each of these decisions are based on substantial expenditures. These expenditures are large in nature. These decisions also involve long-term time frame. These decisions once taken will affect the cash flow, the revenue, the profitability, and growth of the business firm for 5, 10, 20, 30 years. These decisions once taken are generally irreversible in nature. They cannot be taken back. They cannot be reversed. If you stop implementing such plans, then there will be huge losses for the firm. The decision making itself involves complex processes involving capital budgeting methods. So the importance generally lies in the fact that you need to have capital outlays which are huge in nature and which cannot be reversed. So utmost importance must be given to the decision making process before a project is implemented. Implementation of these investment criteria must be evaluated. The evaluation process involves estimating the cash inflows and outflows. It also requires the managers to calculate the estimated required rate of return. So along with cash flows, you need to estimate the required rate of return. That is generally the weighted average cost of capital of a firm. And once you decide on these two things, you need to formulate a plan to bring in a decision rule. So these decision rules are known as capital budgeting methods. For example, if you want to take a decision on the basis of net present value method, that is welcome. You can also make a decision on the basis of internal rate of return method. So there are different methods which can be used by capital budgeting managers. Type of investment decisions. First of all, there will be a replacement project. Old machineries, old assets has to be replaced. So they will cost huge amount of money. So you need to identify those assets which needs replacement, their cost, their depreciation, taxability, funding, etc. Then the second category is expansion projects. You need to expand the plant and machinery, equipments. For example, currently an iron ore project is capable of producing 2 million metric tons per annum of iron ore. But you need to produce more. You need to make it 5 million metric tons per annum from 2 million. So that needs more manpower, more labor, more office space, more design designated stock spaces, more transportation. Everything needs to be more than doubled. So expansion projects needs huge amount of capital inlays, increase in manpower, increase in technical assets, etc. Diversification projects. These projects involve venturing into a new area. For example, a farm which is extracting iron ores from a mines wants to set up a iron factory where the iron ore will be used to extract irons. So that's a new area of expertise which needs huge investment into land, labor, managers, technology, capital, lot of things. Research and development. One needs to keep in mind that future growth generally depends upon the amount of money spent on research and development. So whether the mines under a firm's ownership contains more precious metals like manganese, like other ores, nickels, etc., whatever you can think of, there needs a research to be unearthed. So research and development can also be undertaken for uh, bettering the technology being used. Unless you bring new technology, growth is going to be limited. But research and development is not a one-off criteria. It's a long-term criteria which needs continuous involvement, continuous investment, and perseverance of research and development projects. Investment decision rules. Investments can be made in a project if it is able to maximize shareholders' wealth, if it is able to increase profitability. The management also needs to make sure which method it wants to use to find out which are good projects and which can be undertaken. Bigger cash flows should be preferable to smaller cash flows. Early cash flows from a project are preferable to projects which has later cash flows. So cash flow occurring at the end of year 1 is preferred to cash flow occurring at the end of year 5. It also, the methodology should be able to choose between mutually exclusive projects. Mutually exclusive projects are projects which cannot be undertaken together. If A is undertaken, B cannot be undertaken. You need to find which one you should undertake. So you need to find which one is better between A and B. Capital budgeting process. The process involves 6 steps in general: identifying the projects, opportunities, evaluating the opportunities, increasing various capital budgeting methods, making a selection whether project A is good or B, evaluation involves methods. There are a lot of methods which we need discussion later. Implementing the project once it is selected. If you find project A to be better than project B, B is rejected, A is accepted, you need to implement project A in the most sensible manner to maximize revenues, maximize profit, minimize cost. Then you must control the project. You must control the costs. You must control the implementation process. And last stage, you must review what happened to the project once it ends, whether the project was a success, what is learned from it, how can the project implementation be better, how can cost be minimized, how can manpower can be minimized, how can manpower can be maximized by increasing productivity, etc. So these are steps which are undertaken by management in this process. Now the most important thing is the evaluation process. Evaluation criteria involves, as you can see, 7 methods. 2 of these methods are non-discounting methods, which doesn't involve rate of interest. So these are non-financial criteria. It is a general way of knowing, basic way of knowing whether the project should be undertaken or not. But they are not preferred methods. The preferred methods are discounted techniques, discounted cash flow techniques, which are financial methods, net present value method. It is a most used method. Internal rate of return is a critical method which is difficult, but it is preferred sometimes. So this method and this method, the first 2 discounted cash flow methods, are mostly used. The third method is profitability index method, which is a variation of the net present value method. Discounted payback period is an improvement over payback period. Payback period is a method which doesn't consider the rate of interest or discounting. But this discounted payback period is more or less overcomes that limitation and considers TVM, time value of money, or R. So these are the 6 methods that we will use in capital budgeting decisions. Non-discounted methods, what are they? Like I said, they ignore the concept of interest, they ignore the concept of time value of method, time value of money, but they're pretty useful because they're very easy and they're very scientific in a plain sense of accounting sense of thing. They're not very scientific from a financial perspective, But discounted criteria use time value of money. They're not very easy, but once they're being started to use, they become easy, but they're very precise, they're scientific, they're financial methods. So it is a preferred method over non-discounted criteria. Conclusion. So whatever we have seen till now is that capital budgeting involves taking a decision about investing in a project which presents future growth opportunities, which can maximize wealth, which can maximize profit, which can maximize the usage of resources by a firm. For that, the management of the firm needs to identify projects which is growth oriented, which can be profitable. Capital must also be raised in a timely manner so that profitable projects can be undertaken, can be implemented. If you have identified projects for growth which are good, but you don't have the funds to implement, then it is of no use. So management needs to have capital, needs to have funds to able to undertake these projects in time. Management also needs this as a to be done as a continuous process, not a one-time option, because a project will be finished. So new projects must be undertaken in new years, coming years. So if two projects are undertaken this year, next year some projects has to be identified and undertaken. So new projects, whatever kind of projects they are, expansion, diversification, new products, bringing entirely new set of diversified products, expanding the amount of production. So they have to be a continuous process. So capital budgeting for a firm, business firm, however big it might be, it needs to be a continuous process. A management needs to get involved all the time. So it's not a one-time option which is done and dusted and then we can rest on laurels. So this needs to be a process which keeps on growing and growing and growing. So this year some projects, next year some other projects needs to be undertaken so that a firm is able to grow its business, its wealth, its profits, its value of the stock, value of the firm, and so on. So that's for today in this lesson. Thank you so much for being with me. I'm Samaresh Chotrai. Please subscribe to the channel. Also, don't forget to like the video. You can mail me with this email ID. You can WhatsApp me with your comments and whatever extra materials, examples, PDFs, Word docs you need, so I can provide it to you. And you can also ask for submission of new examples, new documents for solutions, etc. So thank you so much for being with me today, and see you in the next session with a new video related to capital budgeting, how to apply capital budgeting techniques. There will be a lot of videos on capital budgeting, 6 or 7 in all. So please tune in. Next video is coming very soon. Thank you so much. Bye bye.